Sir, very happy morning to all. In this slot, we are going to do, my dear lovable students, a very good topic called as assessment of partnership firm and LLP. There are only few little section to be inserted to that topic because what we have discussed in IFOS, capital gain and PGBP is squarely applicable for this also. So it's a very easy topic, partnership firm and LLP. What is the meaning of the partnership firm? Partnership firm is a relation between person who have agreed to share the profits of the business carried on by all or any of them acting for all. For example, if 4 people are joining A, B, C, D and they are doing a business, and after they do a business they are earning profit. That profit is shared between all the 4 partners, then such a concept is called as partnership firm. The person who have entered into the partnership with another are individually called as partners and collectively called as firm. தனித்தனியா ஒருத்தரையும் பார்ட்னர்ஸ்னு சொல்லுவோம், கலெக்டிவா எல்லாத்தையும் firmனு சொல்லுவோம். So what is a firm? Firm means it is defined in Partnership Act 1932. So Partnership Act 1932 we have defined what is a firm, or as defined under the LLP Act 2008 or in Limited Liability Partnership Act 2008 la naanga discuss pannirkom, that is a firm. So in this we are going to talk about the 5 topics. Number 1, residential status, tax rate and surcharge, special provisions applicable to firm, section 40B and set off and carry forward of loss. Now we are going to talk about a residential status, how to find out the residential status of partnership firm. A resident, such person in resident in India if control and management of its affairs is situated wholly or partly in India. If either the full, whole or part of whole or part of control and management is situated in India, then we can say that they are resident. So control and management of the partnership firm is the key. Is it wholly and partly in India? If it is wholly and partly in India, then they are resident. If it is wholly outside India, then they are non-resident. So such person is non-resident in India if the control and management of its affairs is situated wholly outside India. Fantastic to the core. So what are the salient features of assessment of partnership firm? When you are assessing partnership firm, the following are the salient features of assessment of partnership firm. The firm will be taxed as separate entity. That means partner is different, partnership firm is different. There will be no distinction between registered and unregistered firm. In the Income Tax Act, there is no distinction between registered firm and unregistered firm. Okay. The share of the partner in the income of the firm will not be included in the hands of the partner. It will be exempted under section 10(2)(a). Once the partnership firm pays the tax, that distributed profit in the hands of the partner, it will be exempted under section 10(2)(a). Known point only. Any salary, bonus, commission, remuneration or by whatever name called, which is due to or received by a partner will be allowed as deduction subject to certain restriction. That means if you are a partnership firm, in the P&L account of the partnership firm, a partnership firm alone can debit one extra item like to salary, to bonus, to commission, to remuneration, to whatever name called, enna perla kuptalum seri, and this will be allowed as per section 40B, that is an extra section applicable to partnership firm. Where a firm pays interest to any partner, that means one partnership firm is paying interest to any partner, firm can claim deduction of such interest from its total income subject to certain condition. However, the maximum rate at which interest can be allowed to the partner will be 12% per annum. That means in addition to the remuneration to partners, they can debit to interest on capital to the P&L account. That will be maximum 12%. The income of the firm will be taxed at a flat rate of 30% plus surcharge at 12% if its total income exceeds 1 crore plus health and education cess at 4%. So what is the tax rate applicable for a partnership firm in India? 30%. Plus what is the surcharge applicable? Straight away 12% if the total income exceeds 1 crore. Because for company it is 7%, beyond 1 crore till 10 crore. And health and education cess of 4%. Fine. These are the basics of the partnership firm. So partnership firm assessed as partnership firm if 4 conditions are satisfied. If the 4 conditions are satisfied, then when doing the assessment, partnership firm will be assessed as partnership firm. Number 1, the firm is evidenced by an instrument. There should be partnership deed. Partnership deed should be there. Individual share of the partner are specified in the instrument. For example, A, B, C, D are there. It is 1:1:1:1. Like some ratio of profit sharing should be mentioned in the partnership deed. A certified copy of the instrument accompanying the first return of the income of a firm. When you are filing 139 subsection 1 return, that is a first return, you have to upload the partnership deed. A certified copy of the revised instrument of partnership filed along with the return of the relevant assessment year. Once you change the partnership deed, because of a reconstitution, then you have to upload the latest partnership deed along with the return of income. So if you satisfied the 4 condition, that is the firm is evidenced by an instrument, individual share of the partners are specified in the instrument, certified copy of the instrument accompanying the first return of the firm, and certified copy of the revised instrument of partnership filed along with the return of income of the relevant assessment year. That's it with the first introduction to the partnership firm. So we have understood the residential status. The residential status of the partnership firm is based upon control and management of partnership firm. You have to check whether it is wholly or partly in India, then partnership firm is a resident. Wholly outside India, then partnership firm is a non-resident. Right. I'm moving to the second slot called as tax rate and surcharge. We have done with the residential status. Tax rate and surcharge. For partnership firm, generally tax rate is 30%. Up to 1 crore, no surcharge. But beyond 1 crore up to 10 crore, 12% is a surcharge. 12% is a surcharge. Interest on capital also 12%. Surcharge is also 12%. Partnership firm nale 12%. If it is beyond 10 crore also 12%. So flat rate of 12%. So partnership firm and 12% is having some connection. Whereas company beyond 1 crore up to 10 crore only 7%. Beyond 10 crore only 12%. But partnership firm, sir, from the base, once the total income exceeds 1 crore, we will be levy surcharge at the rate of 12%. With that, residential status, tax rate and surcharge also comes to an end. What are the special provisions applicable to the partnership firm? Special provisions are, we are having certain sections which are applicable squarely only to the partnership firm. Section 184, assessment of firm. When AO pass 143 subsection 3, if you want to treat this as a partnership firm, you should satisfy 184 condition. Assessment as firm. A firm shall be assessed as a firm for the purpose of the act if partnership is evidenced by an instrument. That means partnership deed should be there. The individual share of partners are specified in the instrument. In that partnership deed, profit sharing ratio should be mentioned. If these 2 conditions are satisfied, a firm will be assessed as firm as per 184. That means you don't have a partnership deed, my dear lovable students, or the PSR is not mentioned in the partnership deed, then what 184 is saying that it will not be assessed as partnership firm. So in order to assess it as a partnership firm, the condition to be satisfied is 2 conditions should be satisfied. It should be evidenced by an instrument and PSR should be mentioned in that instrument. What is 185? Assessment when 184 not complied with, notwithstanding anything contained in any other provision of this act, where a firm does not comply with the provision of 184 for the relevant assessment year, the firm shall be so assessed that no deduction by way of any payment of interest, salary, bonus, commission or remuneration by whatever name called made by such firm to any partner of such firm shall be allowed in computing the income chargeable under the head PGBP, and such interest, salary, bonus, commission or remuneration shall not be chargeable to tax under 28 clause 5 in the hands of partner. So what section 185 is saying that If you don't satisfy the condition prescribed under 184, then when you are assessing firm, you cannot assess it as a firm. Hence, sir, 2, remuneration to partners should not be debited to P&L account. 2, interest on capital should not be debited to P&L account. Both will be added back. Since this is adding back, that means it is not claiming it as a deduction in the hands of the partnership firm. This item will not be treated as income in the hands of the partner as per 28 clause 5, that is charging section, which is the 28 super sub. That's it. That means if 184 conditions are not satisfied, then a partnership firm cannot debit remuneration to partners and interest on capital to their P&L account. 185 comes to an end. Can salary and interest paid to partner be disallowed even if conditions of 40B are satisfied is the question. In the following case, the salary and interest paid by firm to the partner shall be disallowed even if the conditions of 40B are satisfied. Number 1, where section 184 subsection 5 applies. 184, if there is a failure on the part of the firm as referred in 144, the salary and interest paid by the firm to its partner shall be disallowed. 184, such salary and interest shall not be taxed in the hands of the partners. Sir, there is no partnership deed, and in that partnership deed PSR has not been mentioned, then it cannot be assessed as partnership firm. Once it cannot be assessed as partnership firm, my dear lovable students, then you cannot debit remuneration to partners and interest on capital to the P&L account. Where section 185 apply, where a firm does not comply with the technical requirement of 184, then salary and interest paid by the firm to its partner shall be disallowed. Kandipa. Such salary and interest shall not be taxable in the hands of the partner. Sir, what they are saying that in 2 circumstances, even though you satisfied 40B conditions, interest to partners and remuneration to partners will not be allowed. Number 1, 184 subsection 5. 184 subsection 5 is best judgment assessment case. This is correct only. Best judgment assessment case. If the AO is doing best judgment assessment, he will not allow, sir, interest to partners and remuneration to partners. Number 2, you have not satisfied the condition what you are supposed to be satisfied as per section 184. Example we are having. 1, rent from house property, dividend, interest on bank deposit or government securities are not chargeable as income from business or profession under section 28. Kandipa, rent from house property is income from house property, dividend is IFOS, interest on bank deposit is IFOS, or government securities also IFOS, right? Therefore, if the profit and loss account of a firm contains these receipts, they have to be excluded while calculating the net profit. Yes, these items has to be removed from the net profit. In the same way, which are to be disallowed under the various provisions from section 28 to 44D will have to be eliminated. If any related party transaction, cash payment exceeding 10,000, if these items has been debited to P&L account should be added back. It naturally follows therefore that brought forward business loss will not be deducted while computing book profit. Brought forward business loss we will not reduce. In simple terms, book profit means income computed under the head PGBP before deduction of partners remuneration. That means a partnership firm can debit remuneration to partners to their P&L account, but it is based upon book profit. When you calculate that book profit, if any salary or remuneration debited to P&L account already should be added back. Accordingly, unabsorbed depreciation can be set off against 32 subsection 2 against such income to arrive at the book profit, but not unabsorbed business loss under section 72. So what basically they are trying to say is a partnership firm can debit remuneration to partners to the P&L account, but that remuneration is based upon book profit. How to compute the book profit? Book profit means all deduction of PGBP except salary, because we are going to calculate only salary, and you can claim unabsorbed depreciation because it is covered in 32 subsection 2, but you cannot claim business loss because it is covered in 72. I will give you an example. A and B entered into a partnership agreement on April 1, 2023. As per the deed, each of them will be entitled to a salary of 2000 per month apart from profit. So 2000 into 12 comes to 24,000. A and B, so into two parties are there, which comes to 48,000. On August 1, 2023, they executed a supplementary deed by which they increased the remuneration to 3,000 each effectively from 1st April. Not possible. Discuss the validity of the supplementary deed. Remuneration will be payable effective from the date of the deed which provide for the payment of such remuneration. In the given case, original deed, the first deed provide for remuneration at the rate of 2,000 for each partner from April 1 onwards. Supplementary deed is executed on August 1, increasing the limit of remuneration. Such increase in the limit of remuneration will be applicable only from 1st April. That means by putting a partnership deed, you cannot do retrospective amendment. You can make only prospective amendment. So 3,000 is not allowed, only 2,000 is allowed, being the date of supplementary deed. Hence, for the period from 1st April 2023 to 31st July 2023, the partners will be allowed remuneration at the rate of 2,000 per month. But from the date of supplementary deed, my dear lovable students, 3,000 rupees is allowed. So we are talking about what are the special sections applicable to partnership firm. Special section, the first section is 184. There should be a partnership deed, and in that partnership deed, PSR should be mentioned to assess as a partnership firm. That's what 184. If you does not satisfy the condition of 184, you have to face the consequences as per 185. While assessing the total income, interest on capital and remuneration to partners will not be allowed as deduction, and it will not be treated as income in the hands of the partner. Now we are moving into, after 184 and 185, there is no 186, we are moving into 187, change in the constitution of the firm. This may happen, there is a partnership firm and that partnership firm has been changed, change in the constitution of firm, where time of making an assessment under 143.3 or 144 or 147 or 153A, now we don't have 153A, but post such assessment was there earlier. It is found that changes occurred in the constitution of the firm. Assessment shall be made on the firm as constituted at the time of making the assessment. Ipo assess firm create panna mari, we will make the assessment. For example, in the partnership firm, Mrs. A, B, C, D, A, B, C and D were partners during the previous year 31/3/2023. Mr. D retired on 30/4/2023. That means we are going to do the assessment from 1st April till 31st March, right? During this period, A, B, C, D all were partners. But after 31st of March, sorry, not 31st April, after 31st of March, on 30th of April, sir, one partner has retired. So there is a constitution in the firm on the date of assessment, because assessment is happening after 31st March. Now, officer make an assessment under 143.3 on the firm for the previous year ended 31/3/2023. On 31/12/2023, he shall make the assessment of the reconstitute of the firm, Messrs. A, B, C. So he has to pass the assessment order on A, B, C, because on the date of passing the assessment order, the firm has reconstituted. The firm has reconstituted. However, as per section 188A, all partners, namely A, B, C and D, shall be liable for the taxes, interest and penalty of the firm for assessment year 23/24. So the assessment order will be passed on the firm who's having existence. Now, on the date of passing assessment order, A, B, C, D is not existing. Only A, B, C is existing, so the order will be passed on A, B, C. So you are saying that D is not responsible for the taxes? No. All the partners A, B, C, D are jointly and severally liable for the taxes. So, if there is any change in the constitution of the firm, where the time of making assessment under section 143, 144, 147, it is found that changes occurred in the constitution of the firm, assessment shall be made on the firm as constituted at the time of making the assessment. So, pass the assessment order on ABC and not on ABCD. Because on the date of passing the assessment order, my dear lovable students, the firm got reconstituted. Now, these are the special sections applicable to partnership firm. 184, you want to assess as a partnership firm, satisfy two conditions. There should be a partnership deed and PSR should be mentioned in that deed. If you don't satisfy 184, then 185 is saying that consequences. You are not supposed to enjoy interest on capital and remuneration to partner. 187, change in the constitution of the firm. After the financial year, before assessment, if there is any change in the constitution of the firm, my dear lovable students, pass the assessment order in the name of the constituted firm and let all the partners who were the partners during that for that year in which the assessment has been passed are jointly and severally liable. I am coming to 188 and 188A. Succession of one firm by another. This is a common thing in the partnership. Where a firm carrying on a business or profession is succeeded by another firm and case is not covered by 187. That is, one partnership firm has been succeeded by another partnership firm. Separate assessment shall be made on the predecessor firm and the successor firm. The predecessor firm shall be assessed in respect of the income of the previous year in which the succession took place up to the date of succession. Successor firm shall be assessed in respect of the income of the previous year after the date of succession. What they are trying to say, I will give you examples. One. From the firm Mrs. ABC, C retired. So A, B, C was there and C retired on 36/2023. Section 187 shall apply. We are having 187 because there is a change in constitution of the firm. Assessment for the previous year 31/3/2024 shall be made on the reconstituted firm Mrs. AB. However, the liabilities of the partner shall be governed by 188A. So, while passing the assessment order, my dear lovable students, the assessment order will be passed on AB, but all the partners A, B and C are jointly and severally liable as per 188A. Fine. So, I have followed 187 read with 188A. I am proceeding, sir. From the firm Mrs. ABC, Mr. A, B, C retire on 36/2023. Yes, sir. And Mr. D and Mr. E and Mr. F are admitted. Fine. So, from the firm Mrs. ABC, A, B, C retire and D, E, F admitted. So, 188 shall apply because earlier this is not a reconstitution of the firm. This is succession of one firm by another because earlier three party was there. They get out and new three parties came in. This is succession of partnership firm. So, here 187 will not be applicable, 188 will be applicable. Separate assessment shall be made on Mrs. ABC for the period 1/4/2023 to 36/2023 and on Mrs. Def for the period 1/7/2023 to 37/2024. That means till the date of succession, my dear lovable students, the assessment will be passed on A, B, C, that is from 1st April to 36, and from 1st July onwards 31st of March the assessment order will be passed on Def because this is not a case of 187, this is a case of 188. Coming to example number 3. Mrs. ABC become Mrs. DBC on 36/2023. Fine. Mrs. ABC DBC மாறினாங்கன்னா A வெளியே போயிருக்காங்க, D உள்ள வந்திருக்காங்க. This is a change in constitution of the firm and 187 shall apply. Mrs. DBC become Mrs. DEC, B வெளியே போயிருக்காங்க, E உள்ள வந்திருக்காங்க on 39. Assessment for the previous year under 31/2024 shall be made on the reconstituted firm Mrs. DEF. Alright. Mrs. DEC become Mrs. DEF on 31/12. This is a case of 187 only because this is only a reconstitution of the firm. So, this is a case of change in reconstitution of the firm and 187 shall apply. Assessment for the previous year under 31/3/2024 shall be made on the reconstituted firm, which is DEF. They are ultimate. But whoever partners were there from start, they were jointly and severally liable. However, the liability of the partner shall be governed by 188A. So, here it is 187 read with 188A. Are you getting the difference between 187 and 188A? If there is a change in constitution of firm, do the assessment in the name of the constituted firm, but all the partners were responsible. 188 is succession of one firm by the another firm, then do separate assessment in predecessor firm and the successor firm. In firm Mrs. ABC, B dies on 36/2023 and the partnership deed is silent about the death of the partner. So, one partner has went out, died. This will result in dissolution of the firm as section 187 shall not apply, 189 shall apply. Because three partners were there, ABC, one of the partner died, but partnership deed is silent regarding what is the consequences of the death, then automatically the partnership firm will get dissolved. Then 187 will not be applicable. What is 187? Change in the reconstitution of the firm. 188 will not be applicable. Succession of the partnership firm. 189 will be applicable, which is dissolution of the firm. Right. Inform Mrs. ABC, Mr. B dies on 36/2023. Okay. And partnership deed provides that firm shall continue on the death of any partner. Or all settu pona kuda partnership firm continue. So this is a case of what? Succession kadayadu. 187 case. This is a change in constitution of the firm, and 187 shall apply. Assessment for previous year ended 31/2024 shall be made on Mrs. AC because only that guy was there. However, the liability of the partners or legal heirs shall be governed by 188A. ஏன்னா செத்து போன ஆள்னால வந்து டாக்ஸ் கட்ட முடியாது. Their legal heirs will pay the tax. From firm Mrs. AB, A retire, that's it, gone. Because ரெண்டு பேர் இருக்காங்க, ஒரு ஆள் ரிட்டையர் ஆச்சுன்னா ரிமைனிங் ஒரு ஆள் பார்ட்னர்ஷிப்பாக கண்டினியூ பண்ண முடியாது. This is the case of dissolution of firm to which section 189 shall apply. Fantastic. Firm Mrs. ABC is converted into a private limited company. This is the case of dissolution of firm to which 189 shall apply. So these are the special provisions. Ipa section number per 184. You want to assess as a partnership firm, satisfy two condition. If you don't satisfy two condition, face the consequences under 185. Then these are special circumstances. 187, have you changed the constitution of the firm, then follow 187. That means do the assessment on the constituted firm, but the tax liability will be on all the partners. 188, have the one partnership firm succeeded by the another partnership firm, then do the assessment in two separate person, predecessor partnership firm and successor partnership firm as per 188. 188A is the jointly and severally liable for all tax payable by the partners, and 189 is firm dissolved or business discontinued. We'll be talking about 188A. Come on. Jointly and sever liability of the partners, tax payable for the firm. Every person who was during the previous year a partner of the firm and legal representative of any such partner whom is deceased shall be jointly and severally liable along with the firm for the amount of tax penalty or other sum payable by the firm for assessment year to which the such previous year is relevant. We are having two examples. A partnership firm consists of partner A, B, C, D. During the previous year ended on 31st March. Partner D retired on 2nd April. That is after financial year, before assessment. The cases of the firm for assessment year 2021 to 2023 are reopened under 147 on 1/1/2024. Okay, fine. Now the taxes, penalty and interest for assessment year 2021 and 21-22 can be recovered either from the firm if possible or from A, B, C or D or from any of them jointly. Thus taxes, penalty and interest of assessment year 22-23 can be recovered either from the firm or from A, B or C or any of them jointly. This is what 188A is saying. Assessment may be passed only on the reconstituted firm, but tax will be recovered from all the partners. Who were the partners at the time this liability arising? Mr. A was partner in firm Mrs. XYZ only for a month in the previous year 31st March. Podume. Mr. A along with other partners and the firm is jointly and severally liable for the taxes, interest and penalty of the firm for the previous year 31st March. If AO is unable to recover the tax, interest and penalty from the firm for the said year, then he can recover the tax, penalty and interest of the firm for the said year from Mr. A because he was partner for 1 month. That's what section 188A is talking about. So these are the special sections applicable to partnership firm. 189, firm dissolved or business discontinued. That's it. Where any business or profession carried on by the firm has been discontinued or where a firm is dissolved, AO shall make an assessment of the total income of the firm as if no such discontinuance or disallowance had taken place. All provisions of Income Tax Act, including the provision relating to levy of penalty, shall apply to such assessment. That means ஒரு பார்ட்னர்ஷிப் ஃபார்ம் இருக்கு, அந்த பார்ட்னர்ஷிப் ஃபார்ம் டிஸ்கண்டினியூ ஆச்சுன்னா இல்ல பார்ட்னர்ஷிப் ஃபார்ம் டிசால்வ் ஆச்சுன்னா AO will make an assessment of the total income of the firm as if no discontinuance. அது டிஸ்கண்டினியூவே ஆவாத மாதிரி, பிகாஸ் டிஸ்கண்டினியூ ஆச்சுன்னு சொல்லி எங்களால் அசஸ்மெண்ட் பண்ணாமல் இருக்க முடியாது இல்லையா. Every person who was at the time of such discontinuance or dissolution of the partner and the legal representative of any such person who is deceased shall be jointly and severally liable. அந்த டிஸ்கண்டினியூன்ஸ் ஆகும்போது யாரெல்லாம் பார்ட்னராக இருந்தாங்களோ அவங்க எல்லாருமே அந்த லைபிலிட்டிக்கு jointly and severally liable or any other sum payable under the act where such discontinuance or dissolution take place after the proceedings in respect of an assessment year have commenced. proceedings may be continued against the person referred in point 2 above from the stage at which proceedings stood at the time of such discontinuance or dissolution, and all provisions of Income Tax Act shall apply. I will give you a masterclass example to make you understand all these stuffs. A partnership formed on 1/4/2011 consists of partner P, Q, RS up to 31st March 2015. Partner P retired on 15th April 2015 and Mr. X was taken in as a partner on that date. So one person get out, other person get in. Mr. Q retired on 15th May 2019. Mr. R retired on 31st December 2021. As on that date, Mr. Y was taken as a partner. The firm is dissolved on 4th January 2024. Finally, super sir. So now you should understand the names of the story, which is P, Q, R, S. A partnership firm formed on 1/4/2011 consisting of partner P, Q, R, S up to 31st March. Partner P retired on April 15th. On 15th of April 2015, partner P retired and Mr. X was taken. So on the same date, sir, Mr. Partner what? P got retired, partner X was taken into the partnership firm. Now the Mr. Q retired on 15th May. On 15th May 2019, Mr. Q retired. Mr. R retired on 31st December. Now on 31st December, R retired. And on that date, Mr. Y was admitted. Mr. Y was admitted as a partner. The firm is dissolved on 4th January. Galida. Sir, 4th January, the firm is dissolved. Fine. Now P, Q, R and S are jointly and severally liable for the taxes, interest and penalty of the firm from assessment year 12-13 to assessment year 16-17. Because if you see on 1/4/2011, they formed a partnership firm. So financial year 11-12, correct? Financial year 11-12 means relevant assessment year, sir, 12-13. So from 12-13 till when the first assessment, sir, P retired on 15th April 2015. So financial year 14-15. He has retired till 15th April only. 15th April 2015. So till financial year 15 he was there. About assessment year 16-17, everyone is responsible. Now Mr. X is also jointly and severally liable along with P, Q, R and S, liable for taxes, interest and penalty of the firm for assessment year 16-17. For the last assessment year, since this new guy has came, for example, this guy, Mr. P has retired on 15th April, no. So in that previous year, he was there, even for a short period, even one day he was there. Mr. X was came into that. So to this list of P, Q, R, S plus the newcomer X, these guys will be jointly and severally liable. Now this guy has went out, X has went out, X, Q, R and S are jointly and severally liable for tax, interest and penalty for the assessment year 17-18 to 2021. Because this is the story up to 16-17. For 17 assessment year 17-18, these guys are responsible. For 18-19, these guys are responsible. For 2021, these guys are responsible. Because, sir, the next one, 15th May 2019, Q went out. That's why Mr. X, Q, R and S are jointly and severally liable for tax, interest and penalty of the firm for assessment year 17-18 to 2021. Now, Mr. X, R and S are jointly and severally liable for the taxes, interest and penalty for the firm from 21-22, 22-23, 23-24 because these guys are continuing the business. Mr. Y is also liable jointly and severally with X, R and S for the taxes, interest and penalty for assessment year 22-23 and 23-24 because these guys was there. Mr. X, Y and S are jointly severally liable for the taxes, interest and penalty of the firm for assessment year 24-25. Provisions of 188A will be applicable because constituted firm pairla da assessment pass out, but whoever were there at the time, they are jointly and severally liable. Mrs. X, Y and S are the partners at the time of dissolution and therefore they are jointly and severally liable for the taxes, interest and penalty of the firm from assessment year 12-13 to assessment year 24-25 as per the provisions of 189. Fantastic to the core. Starting financial year NSR 12-13 learned, that is assessment year 12-13 learned ரிட்டையர் ஆகிற வரைக்கும், ஃபார்ம் டிசால்வ் ஆகிற வரைக்கும், ஃபார்மில் டிசால்வ் ஆகிற டைமில் யார் பார்ட்னராக இருந்தாங்களோ அவங்க liables are, they are liable with the persons referred in 188A. If you are having any confusion with regard to the names, you just draw like this, a table like this, then you can easily knock it off. They started the business from financial year, sir, 1/4/2011, that is financial year 11-12, leave 11-12, come to assessment year 12-13. So this is assessment year 12-13, assessment year 13-14, assessment year 14-15, assessment year 15-16, till what they are going, it goes, sir, till long assessment year. So assessment year 16-17, assessment year 17-18, assessment year 18-19, like that it goes. Now you just fill the column that partners, who and all partners were there. Number 2, partner retire, which partner retire. Number 3, partner admitted, which partner admitted. Effective number of partners, who and all are there till the end. For example, assessment year 12-13, because consists of PQR to 31st March 2015. So 11-15 you can write here itself. So assessment year, no need to go for like this. Assessment year 11-15. So assessment year 12-13, assessment year 12-13 to assessment year 31st March 2015 means 14-15, so 15-16. To 15-16, you know the partners available were P, Q, R and S. P, Q, R and S. These are the 4 partners available. Now what has happened? You just fill the table. And P retired on 15th April 2015. That means previous year 15-16, so assessment year 16-17. So this is with regard to assessment year 16-17. So assessment year 16-17, partner required, P retired on this date. Even though he retired during the year, he was there one day in that previous year, is liable to pay all the taxes. Fantastic to the core. Like that you just fill the year wise, then you read the table, you will be able to get the answer very easily. So these are the special sections applicable to a partnership firm, my dear lovable students, which is 184, 185, 187, 188, 188A and 189. You know, with regard to the assessment of partnership firm, if we discuss this 5 topic, we are done with the assessment of partnership firm. Partnership firm and LLP is the discussion topic. Residential status we have done. It depends upon the control and management, wholly or partly in India resident, wholly outside India non-resident. Tax rate and surcharge generally 30%, surcharge only 12%, partnership firm 12%, interest on capital 12%, surcharge 12%. Special provisions applicable to firm, we are having 184, we are having 185. Follow the stipulated condition, 2 condition, then only we will assess you as firm, otherwise you have to face the consequence as per 185. Then special cases 187, have the partnership firm reconstituted on the date of assessment, pass the assessment order on the reconstituted firm, follow 188A. Then 188, have one partnership firm has been succeeded by another partnership firm, is there any succession of business? Yes sir. Then pass 2 separate assessment order in the hands of the predecessor and successor separately. Then you are having 188A. Sir, even though the assessment has been passed in the hands of the reconstituted firm, whoever may be the partners at the time of, during that year for which the assessment has been passed, they are jointly and severally liable. 189, have the partnership firm died? If the partnership firm has died, that is dissolution. Then you have to pass the assessment order as if the partnership firm has not died, and whoever may be the partners at the time of dissolution are jointly and severally liable from the start of the partnership firm, is what the 189 consequences are all about. The next topic, the next 2 topic with the special provisions of partnership firm also comes to an end. The next 2 topic what we are supposed to be discussed is section 40B, which is a special section for partnership firm, which allows interest on capital and remuneration to partners, and set off and carry forward as per 78 subsection 1. In the coming class, we will be talking about these 2 parts, and we will say that partnership firm and LLP. And after that, we will be doing the past examination questions also. You don't worry at all. Till this you revise. So 4th part 40B we will be discussing. We are having sufficient question for that, my dear lovable students. Then after that, we'll be talking about set off and carry forward. With that, actually the partnership firms things will comes to an end. Then we are having question for practice. We are having lot of question for practice. 5 questions will be solving, which is basically a PGBP question with partnership adjustments. I'll be solving all the question that will make you understand the partnership and LLP in a very level, my dear lovable students. Just go through this part up to this, then the assessment of partnership firm and LLP, you'll be comfortable, feeling so much comfortable. So we'll meet in the coming session to complete the assessment of partnership firm and LLP, unexpected area for examination. Revise very properly, my dear lovable students. We'll meet in the coming session. Revise it, all the assessment part. Do it, the question. Then only you will be able to feel that instead of hearing the lectures. Sit and do the question, various assessment question, assessment of various entities part. Till that, thank you and bye-bye from